I got a question for you. What if I asked you if you'd be interested in making $10,000 a month, having a 75% chance of doing that, and having to invest $250,000? Would that be interesting for you? What if I sweetened the deal and I said you can make $10,000 and having a 75% chance of doing it, but you'd only have to invest about $100,000? Would either of those two be interesting for you? Well, if either one of them is interesting for you, stay tuned. I'm going to show you how I make money using an in-the-money covered call strategy and see if it resonates with you. Here we go. All right, so let's say that you wanted to own a stock. Let's call it Tesla, right? Pretty good stock. And you wanted to give somebody else the right to buy your stock at a certain price. You're willing to limit the upside. So you're willing to say, you know what, I'm limiting the upside to say $260 or something like that. And you said, listen, if it goes over $260, I'm not going to make any money over that, but I will get $10,000 for waiting, okay? So what we do when we sell covered calls, we buy a stock, we buy an asset, and then we give somebody else the right to sell us that asset at a predetermined price, like $260, before a predetermined date, like a month from now. And so that's what we get paid to do. We get paid to hold the asset and give it to them if it goes up. Now, if Tesla goes up a gazillion dollars, you're only going to get $260 for it because you have to sell it for $260. So you limit your upside. Let's take a look at the screen here. And looking at the screen, you see right here, these $260 strike price calls are getting about $10 worth of juice. Now, let me show you what you're looking at. You've got a bid and ask price. The stock right now is about $287 or something like that, $288, somewhere in there. It doesn't really matter that much. And you're going to be buying the stock for about that price, and you're going to turn around and you're going to sell somebody the right to buy your stock from you for $260. And when you do that, you get a benefit of putting $37.70 or a little bit more, probably about $38 back in your account per share. Okay, so let's say you did 1,000 shares. Well, that's going to cost you $287,000, but you're going to get back $37,000. Okay, so it's going to cost you about $250,000, something like that. Okay, so you get back $250,000, but you go over here to this column that says extrinsic value. That's the amount of money that the gambler gives up. Okay, by paying it to you, and that goes down in value as it approaches expiration. When it gets to expiration, it's worth a big fat zero. So at the end of June 6th, it's worth zero. But you get $10 for it today. You also get this intrinsic value. See this column called intrinsic value here? That's the amount that the stock is in the money. The option is in the money. So you pick up this intrinsic value here of $28.45. That's $2,845 per contract. And you also get $1,000 per contract. So 10 contracts or 1,000 shares, you get $10,000. You with me so far? Okay. Now, you might be going, Mark, that's a lot of money. That's $250,000, and I'm only doing it for $10,000 in a month. Oh, I don't know. I think that's pretty good. Think about it for a year. 12 months, that's $120,000 in a year on a $250,000 investment. Not quite 50%, but pretty close. On a stock that I don't know if it's going to go up. I don't know if it's going to go down, but I don't think Tesla is going to be out of business in a year. There's also one other strategy that I'm just going to mention because right now a lot of people who know about options go, Mark, what if you sold a put? Now, a put option gives somebody the right to sell you the stock if it goes down to a certain price. So they're benefiting by the stock going down, and you end up getting it at a certain price that you agreed to. You get the same amount of money. See how it's about 10.05 here in extrinsic value? It's the same amount of money whether you sell an in-the-money call or you sell an out-of-the-money put. Now, the difference is up here. Mathematically, it's the same. The difference is I get to control when I buy the stock and what price I pay for it. Here, you don't get to control when you buy the stock. You end up buying the stock probably on its way down. Now, that's cool. If it goes down to 240 and you say, well, I like Tesla anyway, I'm happy to own it at 260 and then I could sell covered calls against it. That's what a lot of people do. They call it the wheel strategy. And that works. That's valid. I just don't like the negative mindset that you have to end up owning the stock on its way down. So let's say Tesla has some bad news and all of a sudden you own the stock at 260, but the stock trades at 230. Well, you didn't really get much of a choice. You had to wear it at 260. And so now you're kind of in the hole trying to dig out of the hole. It's very similar mathematically, but it's mindset, it's totally different game. So I prefer to sell in the money calls. Now I'm going to sweeten the deal for you, okay? And you don't get this option on the put side. Let's say instead of buying the stock at $287,000 for 1,000 shares, instead you went out here and you went to say, let's go to, I think it's September 19th, and you said, I'm going to go deep in the money, so I'm going to be controlling the same amount of shares, but instead of spending $250,000 or $287,000 in my first example, you're going to end up spending $108,000. Okay? So you could spend a fraction of that. You'll buy these 190 strike price calls. So anything over 190, that's in the money amount, right? So the stock is at 288. It's a couple $100 about, or it's $100 above that. So you got some intrinsic value of about $100, and you got to pay a little bit of extrinsic value. That's a cost for owning this, but not having to spend a whole bunch of money. Make sense? So you spend a fraction, less than half of the amount of money that you spent before, but you're still getting the $10,000 in income in the month. How about them apples, right? Now you're talking about $10,000 a month on $108,000 invested. But remember, you're getting back that $37,000 when you sold it before. So you're going in the money. You're also getting that $37,000 back. So you're not really spending $108,000. You're spending roughly about, I don't know, $70,000. So you get $10,000 back. Think about that. In 7 months, you pay off the whole position, and you still have all that in the money amount that's got some value if the stock doesn't move at all. So here's the math, okay? And I'll put it on the screen here to give you exactly the amounts. But if you buy the stock and you sell somebody else the option to take the stock away from you at $260, you get $10,000. Problem is, you got to spend about $250,000 or whatever the math says here, okay? Or you spend $108,000 and you still get back the $37,000 or so. And so now you're in it for only about $70,000 and you're still getting $10,000 a month. That's an in the money, deep in the money call as your base position. It's called a synthetic. And then I'm also selling a deep in the money strike price on the offense, right? The juice, right? That's what the income is. This is not a capital gain strategy. This is an income strategy. Now let me couple one more thing with it. I'm going to talk to you about delta. Delta is basically the chance of it being at or above your strike price before expiration date. Well, if we go down here and we see this this beautiful call that we have at 260, we've got a 75% because it's got a 75 delta of that being above $260 before your date, right? Well, it is today, so we already know that. But, you know, as the time goes by, that 75 is going to go up as long as this stock continues to stay above 260, which it is today, right? It's got to go down by about 30 points, 28 points or so to get down to that 260. Well, a lot of stocks can do that, but stocks have a tendency to stay where they are, within a little bit of a range. So the farther you go from that range, the greater or the lesser the chance that you're having. And as this stock stays above 260, and as the expiration approaches, you end up making, you got a 75% to an 80% to an 85%. By the time it expires, you got a 100% chance of making this juice, okay? Now, wherever the stock is, you're going to get the in the money amount. So if the stock is at 261, you're only going to get have to pay $1 of in the money amount, right? But you got $10 of this. And by the way, your base position, whatever it is, a stock or the deep in the money option, that moves up and down, or moves up in this case by $1. So to me, it makes a lot of sense to do $250,000 and get $10,000 a month, or you can do the synthetic and you can get $70,000 invested and you get $10,000 a month. Now, what are you giving up? Well, if the stock goes over 260, and it's already over 260, okay? If it stays over 260, whatever the in the money amount is, you have to pay back. Well, you're getting $28.45 in the money amount. So if it's anything higher than that, you're going to have to pay that extra bit back, right? You keep the $28.45 that, you'll pay that back, but you'll also have to pay back a little bit more, okay? All right, it's not the end of the world. Why? Let's say the stock goes up 100 points from here, Okay? So that means it goes to 360. Well, you're going to have to come up with $100 of extra money over the over the 260 to buy it back, okay? But you already got 28.45 on the initial part of the trade. All right? So you're going to have to spend some money to buy it back. You know what else happens? The stock also goes up $100. So that's going to offset. Now, remember I told you about delta, and there's a delta that you have to consider on these in the money synthetics. It's a 90 delta. So if the stock goes up 100, you're only going to get 90 of an increase on that. All right? So essentially, since you got 10 bucks back in juice, that particular month, you're going to have to pay a little extra money if it goes all the way up $100, which we'd love to have happen, but you won't make that much money on the actual trade because all the juice is going to be spent. But if it only goes up $10, you're only going to have to spend back $1 to buy it back, right? So listen, I know this can probably be a little complicated if you're first at it, but the bottom line is if you can just think about it like you're giving somebody else the right to buy your stock before a certain time at a certain price, and by doing that, you're getting the juice, you're getting the extrinsic value. Well, if you do that, then you can make a good amount of money. I mean, $10,000 on $250,000 is pretty good. $10,000 on 70 is really good. There are some downsides to that. I just mentioned one of them. That's if the stock goes up. I don't think that's a big downside at all because if it goes up $100, you still don't lose money. You break even, including the juice. If it goes up a little bit, you make money. You make most of the juice. And then if it goes down, this is where your risk is. And this is where most people lose it on covered calls. They're like, oh, if it goes down, some people say if it goes down, they're happy about it, right? I don't know why you'd be happy with losing money because your base position is going to go down. Yes, you get to keep all the way down to the 260. As soon as it starts going down below 260, you're losing dollar for dollar. Your base position is moving down, and now you're losing in the money amount that gives you that protection. Those things work together as long as the stock is over 260. But after 260, this stops here, and now your account value declines. But if you're in it for the juice, if you're in it for the 10 bucks a month, over time, most stocks, they don't go out of business. They kind of stay in a range. Maybe they break out, maybe they don't. But you're giving up the upside anyway, and in exchange for that, you're getting the $10,000 a month. I hope that makes sense. I do this all the time. I show people how to do this. To me, it's the best way to make money in the market, and I hope you're starting to see it. If not, watch a few more videos on this channel. But thanks for watching all this way, and I'll see you soon. Take care. Hey, it's Mark Yagi, and if you haven't subscribed to this channel, please do that right now. That would be a great favor to me, and plus it helps me get this material out to a lot of other people that might need it. I've got a little bit of a movement going on here, and I want to try to change the world one person at a time, showing them that you can make safe, reliable income from the stock market. And plus it helps to grow the channel a little bit. Also, if you would give me a thumbs up on the video and like it, great. If you don't like it, give me a thumbs down, that's cool. But just tell me why you don't like it so I can get better. And then hit the notification bell so you can get these videos as soon as they come out, because a lot of times this is timely information and you want to get that information before it gets stale. The last thing is to join my free Insider Tips newsletter. There's a link below and you get everything in one spot. You get breaking news and analysis also. So that would be great if you could do that too. See you soon.